Option selling is under attack. Here at the very end of 2023, we continue to live in interesting times and an interesting financial environment. We currently have higher interest rates and low implied volatility. Higher interest rates means your idle cash earns more than it has, and low IV means you don't get paid much premium to sell options. This presents a big question for option selling strategies. Is it worth selling options right now? The option selling premise still works. You can still sell options and make money on the lack of movement of an underlying stock. Time decay, also known as theta, still works in your favor as it always has. But the premium isn't quite there right now. You're not getting paid very much. Meanwhile, your cash can earn more in interest than it has any time in the recent past. Whether it's money market funds, treasuries, or even high-yield savings accounts, cash is king at the moment. You can easily earn interest in the 4 to 5% range, and option selling can be very cash intensive. These strategies tie up your cash so that you can't use it to earn interest. Consider the cash secured put. It's right there in the name, cash secured. Let's say you want to sell a cash secured put on SPY, that's the S&P 500 ETF. Well, you can see in this options chain that a 30 delta put with a 76% chance of profit will earn you around $289. It will also require $46,300 in cash to secure this put. You have to have that cash available in your account. That is, unless you have a margin account. And by the way, that $46,300 can no longer earn interest, not even the 5% rate that Robinhood is currently offering if you have Robinhood Gold. So once you sell the cash secured put, that cash is completely locked up, set aside, and spoken for. It now has only one job, and that is to secure the short put. So there's an opportunity cost for that cash. It can only do one thing at a time. All right, so sticking with that cash secured put example, you would earn $289 on $46,300 of capital in 32 days. That's a 0.62% return and a 7.12% annualized return on capital. 7.12%. And remember that if we choose not to sell this cash secured put and instead use that capital to buy, let's say, US Treasury bills, or even just leave it sitting there with Robinhood Gold, we can earn 5% annualized risk-free. Let's come back to this risk-free point in a moment. But first, I think it's helpful to think about these two choices in terms of how much you could earn per day. If we sell the cash secured put, we earn $289 in 32 days. That's $9.03 per day. If we simply earn 5% interest on the cash, we earn $202.96 in 32 days. That's $6.34 per day. So $9.03 per day versus $6.34 per day, a $2.69 difference. We'll earn $2.69 more per day to sell the cash secured put. And at the end of 32 days, we'll have $289 in premium with the cash secured put, or $203 in interest with the cash. So the cash secured put is still looking pretty good, but we can't forget the risk involved. With the cash secured put, we are on the hook to actually buy 100 shares of SPY if the price falls below the strike price at the expiration date. And that might be a good thing, but if the price keeps falling, we could be looking at a big unrealized loss when we're assigned and forced to buy the shares at the strike price instead of whatever the current price is. The loss can be substantial, and that's why it's important to only sell cash secured puts on underlyings that you want to own. But if we keep our money in cash at Robinhood or a money market fund or in bills with the US Treasury, we earn 5% risk-free. No need to buy volatile stocks, and really no chance of losing our money to anything but inflation. Now, you may look at all this and still decide that selling a cash secured put is the way you want to go. And if you're selling options on an underlying with a higher IV, you'll probably be earning a better annualized return than this example I used with SPY. And that's fine as long as you know the risk. The point of all of this is not to scare you away from selling options, but to always keep in mind the alternative uses of the money and the risk involved. The IV and interest rate environment changes over time. There may be times when it makes nothing but sense to sell options, and there may be times when it makes more sense to let that cash sit safely earning interest or to buy T-bills. And there may be times when the market is so beaten down that it makes more sense to buy the dip. Just because you can sell options and just because you know how to sell options doesn't mean you need to sell options all the time. I think it's wise to take a step back every once in a while, assess the situation, and decide if it still makes sense. When you're an option seller, low IV is not a lot of fun. This is why I enjoy having a larger percentage of my assets in buy and hold strategies, because when IV is low and selling options isn't paying well, that usually means the market is ripping higher, or at least steadily grinding higher, and that buy and hold portion of my portfolio is doing its job over there, increasing my wealth, building additional financial freedom. And right now, even though I have cash sitting in Robinhood that I'm not deploying to option selling at the moment, it is earning a risk-free 5% interest rate. And when rates tick back down or when IV ticks back up, I'll be back at it, selling options more aggressively. It's a win-win situation all around. All right, that's what I have for you in this video. If you enjoyed this one or found it helpful, give it a like. I would appreciate the support. Also, consider subscribing to my channel for more videos on saving, investing, and early retirement. Thanks for watching.